Hey everyone, I'm back with video on part 2 of capital gain, in which I'll be covering rest of the illustrations of Icai study material. In the third part I'll be covering exercise of capital gain, so stay in touch with my channel and please like and share with your friends and subscribe, and also click on the bell icon. Please do watch the video till the end, it will be very helpful. The PDF link is given in the description. So let's start without any wasting any time. Let's start with illustration number 12, as we have already covered till illustration 11 in my first video. You will get it on my channel. Okay, so let's start with illustration number 12. Singhania and Company, a sole proprietorship, owns 6 machines put in use for business in March 2019. Okay, the depreciation of this machine is charged at the rate of 15%. The WDV of these machines as on 1st April 2019 was rupees 8,50,000. 3 of these machines were sold on 10 June 2019 for 11 lakhs. Okay, a second hand plant was brought for 8,50,000 on 30th November 2019. You are required to determine the claim of depreciation for the assessment year 2021, compute the capital gain liable to tax for the assessment year 2021, and if Singhania and Company had sold the 3 machines in June 2019 for 21 lakhs, will there be any difference in your above working? Examine. Okay, as we are seeing that out of 6 machines only 3 machines are sold, and the selling price and the cost of new machine which has been acquired after acquiring the new machine and WDV, its total is it's coming to 17 lakhs. Okay, and the sale proceeds is only 11 lakhs. So for the balance of 3 machines the WDV is available, so no capital gain will arise. Okay, and let's see the answer. Wait a second, sorry, it has gone too much down. Yeah, so let's see the solution. As we see the WDV, computation of depreciation for the assessment year 2021, WDV is 8,50,000 on 1st April 2019. Purchase of second hand plant during the year is 8,50,000, that is coming to 17 lakhs. Okay, sales consideration of old machinery during the years is 11 lakhs. Okay, the WDV of the block on 31st March 2020 is 6 lakhs. On this depreciation will be charged. Okay, since the value of the block as on 31st March 2020 comprises of new asset which has been put to use for less than 180 days. Okay, depreciation is restricted to 50% of the prescribed percentage of 15%, that is depreciation is restricted to 7.5%. Therefore depreciation allowable for the year is 45,000, being 7.5% of 6 lakhs. Okay, they are taking, because the machinery which has been acquired, it has been acquired and put to use for less than 180 days during the year of acquisition, so half rate of depreciation will be charged. Okay, and the second part, it was asked compute the capital gain liable to tax for the assessment of 2021. No capital gain will arise because assets are there in the block and sale value does not exceed the WDV and purchase price of the asset. So let's see the provision under section 50 for computation of capital gain in the case of depreciable asset can be invoked only under the following circumstances: when one or some of the asset in the block are sold for consideration more than the value of the block, then capital gain will arise. When all the assets are transferred for consideration more than the value of the block, then capital gain will arise. When all the assets are transferred for consideration less than the value of the block, then capital loss will arise, and it will shown in the capital gain. Okay, since in the first two cases, the sale consideration is more than the WDV of the block. The computation would result in short-term capital gain. In the third case, since the written down value exceeds the sale consideration, the resultant figure would be a short-term capital loss. Okay. And the third part, it is said that if Singhania had sold the 3 machines in June 2019 for 21 lakhs, then capital gain will obviously arise. We'll see there what difference it will make. Let's see. If the 3 machines are sold in June 2019 for 21 lakhs, then short-term capital gain would arise since the sale consideration is more than the aggregate of the written down value of the block at the beginning of the year and addition made during the year. So here is the capital gain. Sale consideration 21 lakh. WDV of the machine as on 1st April 2019 is 8,50,000. Purchase of second-hand plant during the year is 8,50,000. That is coming to 17 lakh total. And sale consideration after direct sale consideration minus 17 lakhs is coming to 4 lakh short-term capital gain. Okay. Hope you have understood this illustration. Now moving to next one. Number 13. Mr. A is the proprietor of Akash Enterprise having 2 units. He transferred on 1st April 2019 his unit 1 by way of slump sale for consideration of rupees 25 lakhs. Unit 1 was started in the year 2005-6. Okay. The expense incurred for the transfer was 28,000. His balance sheet as on 31st March 2019 is as under. Own capital is given over there, 15 lakhs. Revaluation reserve for building or part unit 1 only, that is 3 lakhs. Bank loan 70% of 2 lakhs is for unit 1, and trade credit 25% of is for unit 1 on 1,50,000. And assets is given: building of unit 1 and unit 2, machinery of unit 1 2, debtors of unit 1 and 2, other assets of unit 1 and 2. Okay. Other information, let's see what it's saying. Other information: revaluation reserve is created by revising upward the value of the building of unit 1. We have seen in that balance sheet as well. No individual value of any asset is considered in the transfer deed. As we all know that while transferring in some sale, no individual asset is sold. All we do is we subtract the net worth from the sales consideration and arise capital gain. Other assets of the unit 1 include patent acquired on 1st July 2017 for 50,000, on which no depreciation has been charged. As we all know, on patent, depreciation at the rate of 25% is charged. So they have not charged any depreciation. We'll charge the depreciation and put the value of the asset on the net worth, and we'll compute the capital gain accordingly. Compute the capital gain for the assessment year 2021. Computation of capital gain on slump sale of unit 1. Sale value is 25 lakhs, it's what given, less expense on sale 28,000. Net sale consideration is 24 lakh 72,000. Okay. Now they have computed net worth. They have shown their net worth. Let's see note number 1 below. So building, computation of net worth of unit 1 of Akash Enterprise. Building is 9 lakhs. As we all know that while computing capital gain for in case of slump sale, revaluation reserve is ignored. So building 3 lakhs revaluation reserve was there, then 12 lakh came. So 12 lakh minus 3 lakh is 9 lakh. Machinery is given 3 lakhs, debtors is given 1 lakh, and patent, as we all know, depreciation will be charged for 2 years. It will be WDV. So see note 2. Moving to note 2. WDV, written down value of the patent as on 1st April 2019. Cost as on 1st July 2017 was 50,000. As it was used for more than 180 days, 25% whole year depreciation will be charged for the year 17-18. Depreciation at the rate of 25% for the financial year 17-18 will be 12,500. WDV is 37,500. Then for depreciation for the year 18-19 is 25% will be charged, and it's coming to 9,375. And WDV of the block is coming on 1st April 2019 is 28,125. Okay. So for the purpose of computing net worth, we'll see to this later. Okay. So we'll put the patent over there. written down value of the patent on 1st April 2019, 28,125. Other assets, 1,50,000 was there, in which it was written there in the note or other information that 50,000 of patent is included in this, so we'll deduct the patent because we have already taken patent value. So 1 lakh other assets, total assets is coming to 14,28,125. okay, less creditors. Creditor is what given in the question, that 25% is for unit 1 and bank loan 70% it is for unit 1. So accordingly they have calculated the creditors and bank loan. Creditors is coming to 37,500 and bank loan is 1,40,000. And after deducting the creditors and bank loan, net worth is coming to 12,50,625. That will be written upside, or it's written there 12,50,625, and long term capital gain has arisen 12,21,375. okay, it is a long term capital gain because it is used for more than 36 months. okay, as we all know, for computing of assets in case of slum sale, 36 months will be considered for computation of long term capital gain. So let's see now. For the purpose of computation of net worth, the return on value determined as per section 43(6) has to be considered in case of depreciable assets. They have taken accordingly. The problem has been solved assuming that balance sheet value of 3 lakhs and 9 lakhs, 9 lakhs, 12 lakh minus 3 lakh, as I told you, represent the WDV of the machinery and building respectively of unit 1. okay, since the unit is held for more than 36 months, capital gain arising would be a long term capital gain. However, indexation benefit is not available in case of slum sale. As we all know, indexation benefit is not available in the slum sale. okay, so hope you have understood this one as well. Now moving to illustration number 14. Mr. K purchased a house property on April 10, 1992 for 65,000. The fair market value of the property on 1st April 1, 2001 was 2,70,000. On August 31st, 2004, Mr. K enters into an agreement with Mr. J for sale of such property for 3,70,000 and receives an amount of rupees 60,000 as an advance. okay, however, as Mr. J did not pay the balance amount, Mr. K forfeited the advance. In May 2008, Mr. K constructed the first floor by incurring a cost of rupees 2,35,000. okay, subsequently in January 2009, Mr. K gifted the house to his friend Mr. D. On February 10, 2020, Mr. D sold the house for 12 lakhs. Cost inflation index is given for the financial year 1 and 2, 4, 5, 8, 9 and 1920. Compute the capital gain in the hands of Mr. D for the assessment in 2021. So in the hands of Mr. K, no capital gain will arise, as it is a gift, and capital gain is exempt in case of gift. In the hands of Mr. D, they are asking. So let's see the solution. Sale consideration is 12 lakh. Index cost of acquisition, we'll see the solution over there down. For the purpose of capital gain, holding period is considered from the date on which the house was purchased by Mr. K till the date of sale. However, index cost of acquisition is considered from the date on which the house was gifted by Mr. K to Mr. D till the date of sale, from January 2009 to February 2009. However, for indexation will do that they are taking a different view, as we have seen in previous illustrations as well in my first video, that they are taking a different view when Mr. D has received. At that time indexation they are taking, but we can take on the basis of High Court judgment of CIT versus J. Manjula Shah, we can take index cost of acquisition for the year in which Mr. K has acquired, that is fair market value. Indexation we can take it of 100 as well. We can solve it that way also. They are taking 2,70,000 cost of the previous owner, fair market value on that day, on 1st April 2001, 2,70,000 into 289, the year of sale, divided by 137. Instead of 137 we can take it 100 as well. okay, we'll see alternative view is given in the alternative view answer. okay, they have the amount has come 5,69,562. If we take that view, that 2,70,000 into 289 divided by 100, then 2,70,000 into 289 divided by 100, then the amount will be coming something 7,80,300. okay, you can take it that way also. And cost index cost of improvement is 2,35,000. This is no changes there. 2,35,000 into 289 divided by 137. okay, in which improvement was done, that is in the year of 2008-9. okay, index cost of improvement and index cost of acquisition is written upstairs, and capital gain has and it is a long term capital gain. So amount forfeited by previous owner, as we all know that previous owner, whatever amount is forfeited by the previous owner is not to be considered and is not to be deducted from the cost of acquisition. So only the amount forfeited by the current owner is to be deducted from the cost of acquisition. okay, so amount forfeited by the previous owner, Mr. K, shall not be deducted from the cost of acquisition. okay, alternative view, as per the view expressed by Bombay High Court in CIT versus J. Manjula Shah 16 Taxman 42, in case the cost of acquisition of the capital asset in the hands of the SEC is taken to be the cost of such asset in the hands of the previous owner, the index benefit would be available from the year in which the capital asset is acquired by the previous owner, as I said. If this view is considered, the index cost of acquisition would have to be calculated by taking the cost inflation index of the financial year 1-2, since the fair market value as on 1st April 2001 has to be taken as cost of acquisition. okay, note, in case Mr. K has gifted the house to his friend Mr. D on or after 1st October 2009, the stamp duty value of the property which was subject to tax in the hands of Mr. D under section 56(2) would be deemed to be cost of acquisition of Mr. Cost of acquisition for computation of capital gain. okay, so they have come up with something note on related to other sources income as well. They're saying that if we have acquired for more than if the difference between the stamp duty value and asset acquired by Mr. D is more than 50,000, then income from other sources will also be taxable in the hands of Mr. D. okay, nothing more is shown over there, but just as stamp duty value is not given, so no question of other sources here. Hey everyone, let's start with illustration number 15. Mr. X purchased a house property in December 1993 for 5,25,000 and an amount of rupees 1,75,000 was spent on the improvement and repairs of the property in March 1997. As we all know that cost of improvement incurred before 1/4/2001 is not to be considered, okay, while computing the capital gain. So it will not be considered. The property was proposed to be sold to Mr. Z in the month of May 2007 and an advance of rupees 40,000 was taken from him. As the entire money was not paid in time, Mr. X forfeited the advance and subsequently sold the property to Mr. Y in the month of March 2020 for 52 lakhs. The fair value of the property on April 1, 2001 was 11,90,000. What is the capital gain chargeable in the hands of Mr. X for the assessment year 2021? As you all know, any amount forfeited by the current owner will be deducted from the cost of acquisition. Okay, so in this case 40,000 will be reduced from the cost of acquisition and then indexation will be done. And financial year 1/2/7/8/19/20 indexation is given, cost inflation index is given. So let's see the solution. Capital gain in the hands of Mr. X for the assessment year 2021 is computed as under sale proceed as it is given 52 lakhs. Index cost of acquisition, let's see the below note 1. Cost of acquisition higher of the fair value as on 1st April 1, 2001 and cost of acquisition higher is taken. Cost of acquisition and fair value, and fair value was higher 11,90,000 less advance taken and forfeited 40,000. It will be reduced as I said, and the amount cost for the purpose of indexation is 11,50,000. Now indexation will be done. Index cost of acquisition is 11,50,000 into 289 divided by 100. Okay. So indexation, index cost of acquisition is coming to 33,23,500. Index cost of improvement is nil, as I said. Only improvement done on or after 1st April 2001 is taken, and before that it is ignored. It's given in the note. Any improvement cost incurred prior to 1st April 2001 is to be ignored when fair value as on 1st April is taken into consideration. Okay, they are taking this, they have written additionally. You can simply write any improvement cost incurred prior to 1st April 2001 is to be ignored. You can simply write that. Okay, so capital gain has come, and this is a long term capital gain. Okay, so move to illustration number 16. Okay, Mr. Kumar has an agricultural land costing 6 lakhs in Lucknow on 1st April 2003 and has been using it for agriculture purpose till 1st August 2012, when the government took over compulsory acquisition of this land. Okay, government has taken this land on a compulsory acquisition. Okay, now a compensation of 12 lakh was settled. Okay, he has received a compensation of how much? 12 lakh. The compensation was received by Mr. Kumar on 1st July 2019. Compute the capital gain taxable in the hands of Mr. Kumar. Cost inflation index is given of different year. Okay, so as we all know, in case of compulsory acquisition of urban agricultural land, exemption is given to an individual and HUF. Okay, if it is used for more than 2 years. Okay, for 2 years before the, at least 2 years it's saying, it's if it is used for at least 2 years before the date of transfer. Okay, so let's see the solution. In the given problem, compulsory acquisition of urban agricultural land has been taken and compensation is received after 1st April 2004. The amount should be received after 1st April 2004. This land had also been used for at least 2 years by the SSC himself for agricultural purpose. So it has been used for more than 2 years. Thus, as per section 1037, entire capital gain arising on such compulsory acquisition will be fully exempt and nothing is taxable in the hands of Mr. Kumar in the year of receipt of compensation. As we all know that in the year receipt of compensation, assessment year 2020. As you all know, compensation when it is received, it was taxable, although the year of transfer is different. But in this case, capital gain will not arise because it's an urban agricultural land and it has been used for 2 years, more than 2 years for agriculture purpose. So 1037 says that it will be exempt only to individual HUF, and Mr. K is an individual, so amount is not taxable in the hands of Mr. Kumar. Okay, now illustration number 17. Will your answer be different if Mr. Kumar had by his own will sold this land to his friend Mr. Sharma? No, then exemption under 1037 is not available, as only in case of compulsory acquisition of urban agricultural land 1037 exemption is available. Okay, as it has sold on his own will, so no exemption will be given under section 1037. As per section 1037, exemption is available if compulsory acquisition of urban agricultural land takes place. Since the sale is out of own will and desire, the provision of this section are not retracted and capital gain arising on such sale will be taxable in the hands of Mr. Kumar. Okay. Now illustration number 18. Will your answer be different if Mr. Kumar had not used this land for agricultural activities? Okay. Examine and compute the amount of capital gain taxable in the hands of Mr. Kumar, if any. So if it has not used for agriculture purpose, then the exemption under section 1037 would not have been available and capital gain would have arise. So will arise and will compute the capital gain accordingly. We'll see how the solution goes. Solution: as per section 1037, exemption is available only when such land has been used for agricultural purpose during the period preceding 2 years by such an individual or any parent of his, if his parents also uses, then also, or by such HUF. It's available to individual HUF. Okay, since the SSC has not used it for agricultural activities, the provision of this section are not retracted, and the capital gain arising on such compulsory acquisition will be taxable in the hands of Mr. Kumar in the year of receipt of compensation, that is assessment year 2021. Okay, sale consideration as it was given 12 lakhs. Cost of acquisition indexation will be done as it is long term. 6 lakhs into 200 divided by 109. See, 6 lakhs. Okay, cost of acquisition was 6 lakhs. Year of acquisition is 34. So base inflation index will be 109, and the year of in which asset has been compulsory acquired, that year indexation will be taken, that is year 1213, and although it will be taxable in the year in which compensation is received, but indexation on the numerator side, indexation will be of year in which compulsory asset was compulsory acquired. So 200 divided by 109. Okay, so let's see the solution. So sale consideration is 12 lakhs, cost of acquisition is 6 lakhs into 200 divided by 109, that is coming to 11 lakh 917. It is a long term capital gain. Okay, now illustration number 19. Will your answer be different if the land belongs to ABC Limited and not Mr. Kumar, and compensation on compulsory acquisition was received by the company? As we all know that 1037 is available to only to individual HUF, so in this case company will not, and it will be treated as capital gain will arise in this case. So let's see the solution. Section 1037 exempts capital gain arising to individual or HUF from transfer of agricultural land by way of compulsory acquisition. If the land belongs to ABC Limited, a company, the provision of this section are not retracted, and the capital gain arising on such compulsory acquisition will be taxable in the hands of ABC Limited. Okay, it was simple. Now moving to illustration number 20. Mr. C purchased a residential house on July 20, 2017. Okay, and made some addition in the house incurring 2 lakhs in August 2017. Okay, he sold the house property in April 2019 for 20 lakhs. Out of the sale proceeds, he spent 5 lakhs to purchase another house property in September 2019. Okay, so what is the capital gain taxable in the hands of Mr. C for the assessment year 2021? Okay, so as we all know, for the immovable property, for taking long term and short term, for considering long term and short term capital gain, we have to take 24 months. If it is sold before 24 months, then it will be short term, and if it is sold after 24 months from the year of acquisition, then it will be a long term. Okay, so in this case, let's see, the house is sold before 24 months from the date of purchase, hence the house is a short term capital asset, and no benefit of indexation would be available. Okay, sale consideration is 20 lakhs, cost of acquisition is 10 lakhs, cost of improvement is 2 lakhs, so it is short term capital gain, that is 8 lakhs. The exemption of section 54, the exemption of capital gain under section 54 is available only in respect of long term capital asset. Remember that in respect of long term capital asset only will get exemption under section 54. Okay, and it is available to individual HUF. In this case, Mr. C is an individual, but it has an asset, capital gain has arisen as is short term, so 54 exemption is not available. 54 exemption is available when residential house property is sold and another residential house property is purchased or constructed. Okay, so in this case it's not long term, so exemption 54 is not available. The exemption of capital gain under section 54 is available only in case of long term capital asset, as the house is short term capital asset Mr. C cannot claim exemption under section 54. Thus the amount of taxable short-term capital gain is 8 lakhs. Okay. Moving to next one. Illustration number 21. PQR Limited purchased a land for industrial undertaking in May 2004 at a cost of 3,50,000. Okay. The above property was compulsory acquired by the state government at a compensation of rupees 12 lakh in the month of January 2020. The compensation was received in February 2020. The company purchased another land for its industrial undertaking at a cost of 2 lakhs in the month of March. What is the amount of capital gain chargeable to tax in the hands of the company for the assessment year 2021? So, as we all know, whenever any industrial land is compulsory acquired, then another industrial land is being purchased from out of the capital gain, then we'll get exemption under section 54D up to the amount of capital gain. Okay, if we spend the whole amount of capital gain in the purchase of new land. In this case, only 2 lakh has been spent on the purchase of another industrial land. Okay, industrial land, so only 2 lakhs exemption will be given under section 54D. On financial year and cost inflation index is given for 4, 5 and 1920. Let's see the solution. Computation of capital gain in the hands of PQR Limited for the assessment year 2021, and it's available to everyone, not to individual HUF only. It's available to any person, any SSC. So sale proceeds is, compensation received is 12 lakh. Index cost of acquisition is 3,50,000 into 289 divided by 113. Okay, that is coming to 8,95,132. So after deducting the index cost of acquisition, the gain is arising 3,04,867. So exemption under section 54D is 2 lakh, cost of acquisition of the land for its undertaking 2 lakh. After deducting 2 lakh exemption, the taxable long-term capital gain is 1,04,867. Okay. Now moving to illustration number 22. Long-term capital gain of rupees 75 lakhs arising from transfer of building on 1st May 2019 will be fully exempt from tax if such capital gain is invested in the bond redeemable after 5 years issued by NHAI under section 54 EC. Examine with reason whether the given statement is true or false having regards to the provision of Income Tax Act 1961. No, it is not correct, because only exemption up to rupees 50 lakhs is available under section 54 EC. So answer, it's false. The exemption under section 54 EC has been restricted by limiting the maximum investment in the long-term specified asset, that is bond of NHAI or RECL or any other bond notified by the government in this behalf, redeemable after 5 years to 50 lakhs, whether such investment is made during the relevant previous year or the subsequent previous year or both. Okay. Therefore, in this case, the exemption under section 54 EC can be availed only to the extent of 50 lakhs, provided the investment is made before 1st November 2019, that is within 6 months from the date of transfer. We have to make investment within 6 months from the date of transfer, remember that. Then only exemption will be applicable. Okay. Now moving to illustration number 23. From the following particulars, compute the taxable capital gain of Mr. D for the assessment year 2021. Okay. Cost of jewelry is given, purchased in financial year 5-6, and cost is 4,52,000. Sale price of jewelry sold in January 2020, that is 11,50,000. Expense for transfer is 7,000. Residential house property, house purchased in March 2020 is 5 lakhs. Okay, so cost inflation index are as follows. 5/6 is this much, 17 lakh or 117, and financial year 1920 is 289. So let's see the solution. Computation of taxable capital gain for the assessment year 2021. Gross consideration is 11,50,000. Expense on transfer is 7,000. Okay. Net consideration is coming to 11,43,000. Now index cost of acquisition. So index cost of acquisition will take 4,52,000, that was cost, and the year of acquisition was, base year will be taken as cost inflation index will be taken 117, and the year in which it is sold is 289. That year in cost inflation index, and indexation has come. So for claiming exemption under section 54F, okay, for claiming any asset, if we sell any asset, in section 54 says that if we sell any capital asset other than residential house property, okay, and we acquire any residential house property, then exemption under section 54F is available, but the exemption is available only up to the cost of new asset into capital gain divided by net consideration. Okay, so let's see the solution. Exemption under section 54F, that's coming to capital gain is 26,521 into 5 lakhs. The amount has been invested. Okay, 5 lakh. 5 lakh has been invested in new house property, and net consideration is given upside, that is after deducting expense of transfer is 11,43,000. Okay, so exemption is coming to 11,601, and the taxable capital gain is 14,920. Okay, now see what they are saying. Consequences if the new house property, it should be is transferred within 3 years from the date of its purchase. What is the consequence? If the new asset is transferred before 3 years from the date of its acquisition, then capital gain would arise on the transfer of the new house, and capital gain exempt earlier under section 54F would be taxable as long-term capital gain. This the amount of 11,601. They are telling that it will be taxable in the year in which the new house property which has been acquired within 3 years, then it will be tax. Then this amount which is exempt will be taxable in the year in which new house property is transferred. Okay, in the given illustration, if the new house property is sold for 6 lakhs after staying 1 year, they are shown example as well, then 1 lakh would be chargeable as short-term capital gain of that year in which the new house is sold. As we all know, for the computation of long-term and short-term, 24 months is to be considered. So if they are sold after 1 year, so it will be short-term. Note, in case the new house, residential house, is sold after 2 years, the capital gain would be long-term capital gain, and indexation benefit would be available. That's simple. And there's also saying 11,601 being the capital gain exempt earlier would be taxable as long-term capital gain. It will always be taxable as long-term capital gain, because when exemption was given, it was long-term capital gain. Okay, and 54F, remember that 54F is available only in exemption is available only in respect of long-term capital asset. So, okay, so 11,601 being the capital asset exempt earlier would be taxable as long-term capital gain of the year in which new house is sold. Okay, now see what they're saying. Consequences where the SSC purchase any other residential house within 2 years or constructs within 3 years from the date of transfer of original asset. You cannot purchase another house property or construct. Okay, then capital gain exemption which was given under section 54F, that will also be taxable in the year in which the new house, residential house property, another residential house property is purchased or constructed. The capital gain exempt earlier under section 54 would be deemed to be the capital gain, long-term capital gain, and chargeable to tax in the previous year in which such residential house is purchased or constructed. Okay, Hope you have understood this one. It was a good question. You can see before the exam it can be asked. Now moving to illustration number 24. Mr. Akash sold his residential property on 2nd February 2020 for 90 lakhs and paid a brokerage of at the rate of 1% of sale. He had purchased the said property in May 2002 for 24,36,000. In June 2020, he invested 75 lakhs in equity of AP Limited, an eligible startup company which constitute 27% of the share capital of the said company. AP Limited utilized the said sum for the following purposes: purchase of new plant and machinery during July 2020 is 65 lakhs. B, included in A above is 8 lakhs for purchase of car. Okay. Air condition purchase for 1 lakh included in A above were installed at a residence of Mr. Akash. Okay. An amount deposited in specified bank on 20th September 2020 is 10 lakhs. Compute the chargeable capital gain for the assessment year 2021, assume that Mr. Akash is liable to file the return of income on or before 30th September and he files a return on 29th September 2020. Cost inflation index 2002-3 105 and 2019-20 is 289. As we all know, whenever any person transfers any residential house and invests the amount of capital gain in and acquires the shares of an eligible startup company. Okay, an eligible startup company invests that amount received from the person, individual HUF, into the assets, new assets. Okay, new asset is given in the provision part, which are not included in the new assets. So if they invest, the eligible startup company invests the amount received in the for the purchase of new plant and machinery. Okay, then the individual HUF will get the exemption under section 54 GB. Okay, but if it is not invested, then capital gain will be taxable in that year. So in this case, as he has invested in the Akash has invested in eligible startup company and is acquired more than 25% shares, so he will get exemption, but only up to the amount. Up to how much amount? Only up to the amount of capital gain, and the new plant and machinery should be purchased on or before the due date of filing of return of income of Mr. Akash. Okay, so let's see the solution. Computation of taxable capital gain for the assessment year 2021. Gross consideration 90 lakhs, less expense on transfer 1% of the gross consideration, that is 90,000. Net consideration is 89 lakh 10,000, less index cost of acquisition is 24 lakh 36,000 into 289. Okay, the year of transfer and the year of acquisition is 105. That year cost inflation index 105. So index cost of acquisition is coming to 67 lakh 4,800. Okay, and the capital gain is coming to 22 lakh 5,200. Okay, exemption, we'll see the note below how the exemption is calculated. So 22 lakhs 5,200, as we all know, it is capital gain is computed similar to section 54F. Okay, capital gain into the amount invested in the new plant and machinery divided by net consideration. So capital gain is 22 lakh 5,200 into 66 lakh. How 66 lakh came? That is the amount invested in new plant and machinery by the eligible startup. Let's see how much they have invested and how much it was eligible. Which is not eligible, it will be removed. Okay, so purchase cost of new plant and machinery acquired in July 2020 is 65 lakhs, less cost of vehicles is not included, that is car 8 lakhs, cost of air condition installed at the residence of Mr. Akash, 1 lakh, that is also not included. Okay, that is what is it was for the personal purpose of that Mr. Akash. So 1 lakh is removed. Total is 9 lakh has been removed. That is coming to 56 lakhs. Okay, amount deposited in specified bank, it is also allowed before the due date of filing of return. The amount can be deposited in the bank, okay, for specified purpose, and the amount should be used for that purpose only. Okay, so 10 lakh it was, and total is coming to 66 lakhs. Deemed cost of new plant and machinery for the exemption under section 54 GB is 66 lakhs. So let's compute the exemption. 22 lakh 5,200 into 66 lakh divided by net consideration is 89 lakh 10,000, and the exemption is coming to 16 lakh 33,481, and taxable capital gain is 5 lakh 71,719. Okay, so it was also a good question. You can see it once again. It can be asked in the exam. Okay, so this thing has these 2 lines. Just simply ignore. I have my mistake. It has come in this PDF file. Okay. Now let's start with illustration number 25. Calculate the income tax liability for the assessment year 2021 in the following cases. Mr. A, aged 45 years, he is a resident. Mr. B, aged 62 years, he is non-resident. Mr. C, aged 81 years, he is a resident, and Mr. D, aged 82 years, he is non-resident. We'll go by one. Okay, let's start with Mr. A. He is 45 years, he is a resident, so he will be getting a basic exemption limit of rupees 2,50,000. Okay, so his total income other than long-term capital gain is 2,40,000. Long-term capital gain is 15,000 from sale of vacant land. Okay, so computation of income tax liability for the assessment year 2021. Residential status is resident. Applicable basic exemption is 2,50,000. Asset sold vacant land. Long-term capital gain is 15,000 on sale of above asset. Taxable at the rate of 20% under section 112. Okay. Other income is 2,40,000. Okay. As basic exemption, he is getting basic exemption of 2,50,000. So other income is 2,40,000. So the amount basic exemption is not fully exhausted. So 10,000 is not exhausted. So on long-term capital gain, basic exemption will be available up to rupees 10,000. So only 5,000 will be taxable at the rate of 20%. Okay, on 5,000 on long-term capital gain, after adjustment of unexhausted basic exemption of 10,000, that is 20,000 on 5%, 20% on 5,000, that is coming to 1,000. As his total income is up to 5 lakhs, so he will be getting a relief under section 87A, as is available to only resident individual. So he is a resident individual, so he will be getting a relief under section 87A of up to rupees 1,000 of 1,000, and health and education says is nil, as tax is nil, so tax liability is nil. So now see for Mr. B, aged 62 years, as he is non-resident, so he will be getting a basic exemption limit of only 2,50,000, not 3 lakhs. Okay, as he is a non-resident, for non-resident basic exemption limit is only 2,50,000. So his total income other than long-term capital gain is 2,80,000. Long-term capital gain is 10,000 from sale of listed equity shares, STT paid on sale and purchase of shares. So 112 will be applicable, but as his income is below 1 lakh, so no amount will be taxable under section 112A. So let's see the solution. Mr. B, aged 62 years, non-resident है, and basic exemption is 2,50,000. Listed equity shares, STT paid on both purchase and sale of shares. Long-term capital gain 10,000, exempt under section 112 since it is less than 1 lakh. Okay, other income is 2,80,000. On 2,80,000, 2,50,000 basic exemption, that is 30,000. On 30,000 he will be have to pay tax at the rate of how much? 5%. Okay, on 30,000 you have to pay 5% tax, that is coming to 1,500. He will not be getting relief as he is a non-resident. So After adding health and education cess of 4%, it's coming to tax liability is coming to 1560. Okay, now let's see Mr. C, aged 81 years. He's a resident, so he will be getting exemption of 5 lakhs. Okay, total income other than long-term capital gain is 5,90,000. Long-term capital gain 60,000 from sale of agricultural land in rural areas. Sale of agricultural land in rural areas. Rural area is not covered in the capital asset, so it will not be chargeable to long-term capital gain tax. So let's see the solution. Applicable basic exemption limit is 5 lakhs. Rural agricultural land asset sold is okay. Long-term capital gain 60,000, exempt, not a capital asset, as I said. Other income is 5,90,000. Okay, on this only on 18,000, that is only on 90,000 he has to pay 20% tax, that is coming to 18,000, and health and education cess will be added 4% and it's coming to 18,720. Okay, now see Mr. D is a non-resident. Total income other than long-term capital gain is 4,80,000. Long-term capital gain is nil. He will be getting a basic exemption of 2,50,000. Okay, after he will getting a 2,50,000 basic exemption. So total income is 4,80,000. So after deducting 2,50,000 basic exemption on 2,30,000. On 4,80,000, after deducting 2,50,000, it's coming to 2,30,000. On that 5% will be charged, that is coming to 11,500 tax, and after adding health and education cess of 4%, it's coming to 11,960. Okay, now see what the note is saying. Since Mr. B, Mrs. B and Mr. D are non-resident, they cannot avail the higher basic exemption limit of 3 lakhs and 5 lakhs for persons over the age of 60 years and 80 years respectively. Okay, since Mr. A is a resident whose total income does not exceed 5 lakhs, he is eligible for rebate of 12,500 or actual tax payable, whichever is lower, under section 87A. Okay, so that's it with all the illustrations and exercise I will be covering in the next part. Hope you are able to understand. If there is any doubt relating to this chapter, write me on the comment box. Please don't waste time as the syllabus is too huge and only 3 months are left. Okay, so please work hard, study hard, and stay healthy and eat healthy. Okay, and please don't forget, if you do like my channel, share my videos and share with your friends as well, and subscribe the channel. And another announcement, if anyone willing to solve ICI indirect tax study mat ICI questions, okay, indirect tax ICI study mat questions, please see the comment box in the description box. Sorry, not in the comment box, in the description box I have given the link of that channel, and it's a good channel. You can subscribe that as well. Please do like, share and subscribe that channel as well. Okay, thank you very much. Stay healthy, stay happy. Bye bye.